Welcome to another episode of JEMtrades, where we share tips and tricks to kite-send your trading into profitability. So today we're going to look at advanced candlestick management, and this is particularly useful if you're trying to catch large risk to, or reward to risk trades using a relatively small stop against a big support and or resistance level. So in this case, on this YM chart from Friday the 21st of October, I had a support level here on the 30-minute chart. Obviously, if you're going to say I'm going to use a 30 tick stop, then you'll be able to get into places and then the stop will hold, but then you need a much bigger move to make the risk to reward worthwhile. So if you want to get a really high reward to risk ratio, you need to go in with a tight stop, and a tight stop is prone to being stopped out regularly when playing off of higher time frame supports and resistances. So in order to remedy that problem, you need to use advanced candlestick management. So most people know this at the end of a downtrend, that's a hammer. If it's at the end of a downtrend, then that signifies, or that suggests, that the trend may turn, and that allows you to catch long opportunities off of a support. The opposite is true. This is a shooting star. If you've got an uptrend and you find a candle like this with a long upper shadow and most of its body, all of its body near the lower half of the candle, sometimes you'll get a little shadow here as well, or a longer one, but as long as it's towards the lower end and it's a relatively small body in comparison to the whole of the candlestick body, then that is a shooting star, and that will signify a downtrend or a change in trend from uptrend to downtrend. So looking at wicks, you may say, well, hey, look, here's a hammer, go long. If you go long here with a 10 tick stop, you end up being stopped out somewhere around here. So the trick is you need to wait for the polarity to change. So the first thing to note is this candle's too small in comparison to the bigger move. So the amateur who's rushing to get in will take a long here. The professional will wait until a bigger, more congruent candlestick, which would be this one right here, the close on this candlestick, because the wick is big enough to offset this downtrend. But you get stopped anyway. So, but this is worth noting. This entry here, I believe is 990 right here. So let's keep this number in the back of our minds as we move forward. So you got lower lows, lower highs, you got a downtrend. Then you get your first higher low, and you say, hey, maybe this is going to turn around here, let's have a look. But it's still, you need another confirmation to confirm the change in trend. So you got higher lows now, but you still have your lower highs. If you look at wicks as being your tell for either pivots and or wicks. So because the price action is very choppy and there isn't that many bars on either side of each pivot, we move towards wicks. So you've got low, 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 and then you get the first higher high. So now you've got higher, a low here, goes here, down here, higher low, not a higher high yet, and then higher high. So at that stage, this is where you've got the confirmation that the trend may well have changed now. So some people, again, they would just go in at 90. If you did, you got a little bit, I think that's eight ticks of mass adverse exposure, so 8 out of your 10, so your stop would have held. But for an even better entry, you look for the trap, right? So you got the first entry here, you got stopped. Next entry here, you wouldn't have got stopped, but you got some heat. And then the third and final entry, would be looking for a trap on this right hand side. Once you had the change in polarity in terms of wicks and higher lows and higher highs, you look for a trap. You've got a wick here which acts as support. It falls through with a big red candle, big green candle to close back in, and then another wick on the right hand side. On a small enough, or if we were to blow this price action out and instead of looking at 5-minute bars looked at 1 minute or 15 seconds, we would see a head and shoulders with a sharp move down and a sharp move up. Once you get that, then you put your order in, and this is the key part, you put your order in at the first bona fide trigger, which, if you remember, was right back here. If you do that, you take 2 ticks of heat, and you have up to here is about, this is 40, got in 90, so that's a 5-to-1 reward to risk ratio with very little heat. This is because we're going off of a large time frame, and we're timing it with a relatively small stop by using advanced candlestick analysis. So that's the little lesson for today. If you like this type of thing, go ahead and give it a like. Subscribe if you want to see more of this type of thing. And as always, remember to stay stupid and follow the plan. See you all next time.